Hello and welcome to this session. This is Professor Farhat, in which we will discuss uncertain tax position known as UTP. Now, many students find this topic complicated or challenging. I'm going to try to simplify this as much as possible without using the technical language. So let's start by defining what is an uncertain tax position. Well, it's a position when the company's decision is unclear about a tax situation, and that position may not be accepted by tax authority upon review or audit. What does that mean? It means the company is taking a deduction on their tax return or not including an income. So there's an income and they're not including this income, or taking some sort of a tax credit. Whether you are taking a deduction, you're taking a tax credit, or not including an income, the bottom line is you are trying to reduce your taxable income, and by reducing your taxable income, you are trying to reduce your taxes. That's the whole purpose of taking this position. It takes many forms. The question is, what happened if you were audited? What happened if the tax return was reviewed? Would this position be withheld? In other words, would that deduction goes through, or would it be rejected by the IRS? Will that credit be honored? Yes, this is a research and development credit, and yes, you did compute it properly, you qualify for it. Or would that income that you considered non-taxable, would it be considered taxable? In other words, you're not paying taxes on it now. Is it going to be taxable? Think of this as like driving on a foggy road, navigating a foggy road. Well, guess what? Just as the fog obscured the way forward, uncertainty in tax law makes it unclear whether a company decision will be accepted by authorities. Now, if the law is clear-cut, it's yes or no, then that's fine. Then uncertain tax position don't exist. It's either clear-cut deduction or it's not a deduction. Under certain circumstances, the law, the tax rules are not clear. So that's why we do have this uncertain tax position. Now, as a CPA candidate, I'm going to go over some examples when the tax position may not be clear 100%, but we don't have to worry about this. In practice, people in practice will have to deal with this situation maybe on a day-to-day basis. From a CPA perspective, you need to know how to account for an uncertain tax position. So the company takes an aggressive position to reduce their taxable income. What's an aggressive position? Either you took a deduction, you took a credit, and you're not sure if that deduction is in quote legitimate, or there are certain taxable income that you're not including. I know I'm repeating myself. I just want to make sure you understand how does this uncertain tax position comes into play. If the position later on is not sustained and retroactively disallowed, so let's assume you were audited or the tax return was reviewed and the IRS said, no, hold on a second, we're not going to accept that position. We're not going to accept this deduction as a deduction. Or you went to court and the court invalidate your deduction or your credit, or there's a new regulation that clarified this deduction and said, you know what, it's not acceptable. So some subsequent event occurred, and now you know that deduction, that reduction in your taxable benefit was not, in quote, legitimate. What do you have to do? Well, if that happens, let's think of it just from a logical perspective. So you took a position, your taxable income went down. 2 years later, you find out that position that you took was not acceptable. So what's going to happen? Your taxable income will go up, and you might be incurred the penalties, interest. We're not going to get into this, but you're going to have to pay your taxes, and maybe with additional interest and penalties. Again, I'm not going into the interest and the penalties, but the point is, if this happens, it means in the future you might have a liability. What does that mean? Well, think about contingent liability. Same concept. If you are going to have a liability into the future, if you think you're going to owe money, what do you have to do today? If you think you are going to owe money, you have to book a liability. And this is where this uncertain tax position takes place. You took a deduction, you took a credit. Then you'd say, okay, I took this. I'm not really sure if it's going to, in the future, it's going to be reversed or not. Well, on my financial statement, remember, you took that position on your tax return. That's fine. You took your position, and we're going to see when and how you take that position. Then from a financial statement, what do you have to do? On the financial statement, you might have to book a liability. And we're going to look at the rules, but that's the big idea. I'm going to show you an example. I'm going to look at the rules first, show you an example, and work an MCQ to kind of just get you familiar with what do you need to know for this topic on the CPA exam. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com. Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today. We're going to look at this situation from a US GAAP, not from a tax perspective. From a tax perspective, we are assuming that you took the position. From a GAAP, from a financial statement perspective, what would FASB required? Well, FASB set up guidelines for company to decide if a tax position are likely to stand up to an audit. And here are the rules. Basically, this is what they called test 1. Companies need to figure out if there's more than 50% chance that their tax position, whether you took a deduction or a credit, will be accepted if the tax authority checked their books. So they would say, okay, think of it from a tax perspective. If you were audited or if your tax return was reviewed, would that position be accepted by the IRS? If the chance of that position more than 50% being accepted, the answer is yes to test 1. Then if it's yes, then we're going to have to go to step 2 and book a liability. Determine if it's accepted, how much of it is accepted. If the answer is no, it's not going to be accepted, we stop. If the IRS don't do that, you should not be taking that position anyway in the first place. But the question is, would it be sustained? If the answer is yes, it will be sustained, and you took that position, then we're going to have to determine how much of a liability you need to book. So if the company thinks it's more than 50% likely that their tax position will hold up under audit, they can record this as a benefit in their account, reducing how much they owe in taxes or increasing their assets. So if they think it's more than 50%, they're going to take the deduction because they think it's more than 50%. And on the financial statements, they might have to book a liability. If the chance is less than 50%, they should not include this potential benefit in their financial record because there's no chance of that taking place. And if that's the case, they should not even take the deduction on the tax return. Here what we assume an audit is going to take place. In making these decisions, companies will assume we're going to be audited. We don't assume, well, there's a low chance of being audited. We're going to assume we're going to be audited. Our filing will be audited. And if the company decides its tax position is likely to be approved, it means more than 50%, then they need to figure out how much to adjust their tax asset and liabilities in their financial record. Yes, there's more than 50% it will be approved, but they have to determine sometime what's going to happen. The IRS may accept part of it. Maybe they accept 60, 70, 80% of that deduction, and the remainder they said, no, it's not acceptable. Or between the client and the IRS, they may come to an agreement. The IRS might say, look, the law is vague. Let's cut this deduction in half and we'll accept half of it. Or you might tell the IRS, look, I'm willing to take 60% or 40% of that deduction. And if they agree, the government would settle. So there's also that probability that you might go into a settlement with the IRS. You have to take that into account. So in essence, what you're doing, you are being cautious and realistic with tax claim, ensuring that companies only account for the benefits that they are fairly confident they will be allowed to keep after a potential audit. So they have to think like, if we're audited, we might have to settle and get less of the deduction. So how much will we get? This is what we're going to book. And this is what we'll see in the example. Now, you might say, what are those disputes? You might get into a dispute for the IRS for many reasons. And once you have a dispute, you might have this situation, uncertain tax position. You might be claiming a deduction, taking a business expense, or a donation to lower your taxable income. And that could be questionable. Well, you could be choosing to not to file a tax return in certain areas. In other words, not pay taxes in certain areas due to lack of business presence. That could, arise to a tax dispute with that authority. You could be allocating income across different regions, across different states to optimize taxes, which is transfer taxes, and that could raise some questions by the IRS. You might be deciding to report certain income of active versus passive, ordinary versus capital. That could also arise some tax dispute. You could be opting not to report certain income deemed non-taxable. You think it's non-taxable, and classify certain transaction or entities as tax exempt, and they may not be. Well, that might arise to a tax dispute. The reason I'm giving you all these options is just I want you to think that why would a tax dispute occur? The classic one and the easiest one to understand is you took a deduction and the IRS might question this deduction. So these positions that are listed here, they carry some level of uncertainty and the risk of dispute with the taxing authority. So let's take a look at it. Let's start to kind of put this down in practical terms. So let's assume you are preparing your tax return and it's a corporation, they're preparing their 1020. Let's assume they took a deduction of $100,000. That deduction is not 100% clear. The law is not 100% clear. There's some ambiguity about this deduction. It should be considered an asset. It should not be considered a deduction. We're not sure. There's some ambiguity. So, if the chance of this deduction surviving a review or an audit by the IRS is less than 20%, don't take the deduction. We stop if there's any less than 50%. If the chance of the deduction surviving a review or an audit by the IRS is more than 50%, you're going to take the deduction, that's fine, and you have to do something on the financial statement. Now, when you make this analysis, you take into account the current tax law, regulation, and any relevant court cases. You want to make sure if you took a deduction, it's going to stand. At least you have more than 50%. Now, how much is this going to be? How much of a deduction you are going to take? Well, you're going to take the deduction of $100,000, but on the financial statement, you have to determine how much you should book as a liability. So yes, you took the deduction on the tax return because there's more than 50%. You think it's going to survive, but how much you're going to take on the financial statement. So what you have to do here, you have to determine how much is the benefit that's going to be taking net. Well, this is what's called step 2. So this is step 1. So we took step 1, and step 1 we said yes, there's more than 50% chance. Step 2 is how much? Well, we're going to evaluate the range of possible outcome between the dispute between you and the IRS, and select the amount that has the greater than 50% chance likelihood of being accepted by taxing authority. The best way to illustrate this is to look at a complete example. Okay, let's take this 100,000 and put it in an example. So Tech Innovation, which prepared its year 1 tax return and decided to take this 100,000 questionable deduction. This deduction would result in a savings of 21,000 given a tax rate of 21%. So if we took the deduction reduced our taxable income by 100,000. As a result, gave us a tax savings of 21,000. Now, the company believes there's a greater than 50% chance that if audited, this tax deduction will be sustained as filed, meeting the more than likely than not test, which is the test 1. So we think there's more than likely a chance that this deduction will stand and will have a deduction of 21,000. Now there's more than 51% chance, right? But there's a chance where we might lose it altogether. There's a chance the IRS might say, we're going to give you half of it, or 75%, or 40%, or you may just settle with them. Just, you know what, give me 40% of that deduction. Okay. So Tech Innovation also anticipate if challenged, it would be likely end up negotiating settlement. And we're going to look at the assessment of the potential outcome. So what would Tech Innovation decides to do? They would say, okay, here are the probabilities. There's a 20% chance that we will get the full savings, the 21,000, the full savings. Now, these probabilities, now remember, there's a more than 51% it will be acceptable, yes. So please don't confuse the greater than 50% chance, more likely than not test with the probabilities. First, the test 1, this is test 1. Test 1 is saying, is there more than 51% chance we can take the deduction? This is test 1. The answer is yes or no. In test 2, there's various probabilities. The first probability is there's a 20% probability that the IRS will accept our position 100%. There's a 20% probability. And so far, the cumulative probability is 20%. The IRS accepting rather than 15,000, accepting rather than accepting than 21,000, accepting a $15,000 savings, there's a 32% probability of the IRS saying, you know what, rather than 21%, we're going to accept 15,000 of savings. And there's a 32% chance of that. Now the probability, you have to add the probability, the cumulative probability. Well, 20% chance gave you a 20% probability. There's a 32% chance, a higher chance that the government might accept 15,000, gives you a $15,000 savings on this deduction. Well, if that's the case, your cumulative probability is 52%. Here's what's going to happen. Once you reach cumulative probability more than 50%, this is the probability that you will assume it's going to be realized. So although you took a deduction of 21,000 on your tax return, but you're going to say, look, yes, I took the deduction 21,000. If I'm challenged, I can get away with 15,000. What does that mean? Well, it means I took a deduction the day of 21,000, but I think this deduction, this savings will be only 15. It means I am going to potentially lose, think of it, 6,000. 6,000 of a deduction. I'm going to lose that. Why? Because there's more than 50% chance, according to my probability, that I will settle with the IRS at 15,000. But right now I'm taking 21. What does that mean? It means in the future I might lose the 6,000 of savings. It means in the future I have to account for a liability because I may end up paying more because I'm going to lose my savings. Then a $10,000 savings, there's a 23% probability. The cumulative now goes up to 75. And only a $5,000 savings at the 15% probability. And at this point, it's 90%. And no savings, which is they say, you're out, we're not going to give you any deduction. There's a 10% probability that they would say, we're not going to give you anything. Okay, but what we did is once we reached more than 50%, we stop there. We take that highest probability. Now, what are we going to do then? So what are we going to do now? Well, based on this more than 50% probability, for a financial statement perspective, the company should recognize a tax savings / benefit of only 15,000. Well, on the tax return, we were benefited 21. On the financial statement, we are going to take only 15. So this amount, the 15,000, is the largest benefit that has a greater than 50% chance cumulative probability of being realized, because once we reach more than 50, which is at this level was 52%. To reflect this in our financial statement, we must record a liability, income tax liability adjustment. Originally, with a full deduction, the expected saving would have been 21,000. And this is exactly what we took on the tax return. We took the full deduction. But from a financial statement perspective, we have to be conservative. We have to tell the users, yes, we took this deduction, but there's a chance we might lose the 21,000 original savings and only recognize 15. It means we have to book an additional expense of 6,000 and book a liability called income tax payable uncertain tax position. So this liability is like a special liability. It's uncertain tax position. So we took the deduction. So on the tax return, we're happy we took the deduction. The deduction gave us $21,000 in savings. On the financial statements, we're going to say, you know what? Yes, we took the deduction, but there's a chance we could be audited. If we're audited, we think we can settle for 15, and therefore we're going to lose $6,000. Therefore, from an income tax perspective, from a financial statement perspective, we have to book an additional expense and book a liability of 6,000. Now, obviously, if we're audited, we have to pay back the IRS, and on the tax return, we just simply have to pay the taxes. That's on the tax return. Again, remember what we're looking at here in this whole UTP is the financial statement. We're looking at GAAP. We're looking what we're doing with GAAP. So when do you remove this liability of $6,000? That is income taxes payable UTP. Well, one scenario is you were audited and you settle the liability. So the IRS audit you and they say, you know what, we're going to accept it. And for simplicity, we're going to say we accept it exactly for the 6,000 that you thought you will. So they accepted exactly what we thought they will. Therefore, we debit. So under those circumstances, you debit income taxes payable UTP 6,000. And you credit cash 6,000, and this liability is gone, and we end up paying the cash. So that's one possibility. They may settle for more than $6,000, for less than $6,000. Just you were audited and settled the liability. Or the statutes of limitation expired after 3 years. That's it. They can no longer go back and ask for this. We reverse this. If that's the case, we reverse this. Or there are new rules or regulation or court cases clarifying the ambiguity about that $100 deduction that we took that resulted in $21,000 in savings. If the ambiguity is clarified to our favor, it means this payable that we thought we're going to pay would be no longer the case. Then we will reverse the entry. Let's assume it was in our favor. It means, well, that's it. We took the deduction. We thought we're going to be responsible for $6,000. We're no longer responsible. We're going to take the full savings. Or it was against you. Then you have to book an additional income tax expense of $15,000, credit income taxes payable of $15,000, and we might incur penalties and interest, which is, for taxes. We don't want to get into this. But the point is, once the new rules and regulation or court cases clarify that ambiguity, if that happens as well. Let's take a look at this multiple choice question from farhatlectures.com. If a company's uncertain tax position is estimated to have multiple potential outcomes, the amount to recognize in the financial statement should be what? Simply put, they're asking us here for test 2, how much you would record as a liability about this uncertain tax position. Is it the sum of all possible tax benefit? No, you don't add up all the possible tax benefit. A is out. The minimum amount in the range of possible outcome. Well, not the sum and not the minimum. You're not going to do, the sum is everything and the minimum is the minimum. The maximum amount that has more than 50% likelihood of being realized. Yes, the maximum amount that have more than 50% likelihood as a cumulative probability of being realized. That's what you will record in the financial statement. A weighted average of all potential outcome. No, you don't get a weighted average. So the answer is C. You have to know how to book that test 2. The maximum amount that has more than 50% likelihood of being realized. Choice C is the correct answer. So what you have to do, the company should recognize the largest amount of benefit that's more than 50% chance likely to be realized upon settlement. And remember that 50% is the cumulative probability. What should you do now? You want to go to Farhat Lectures, look at additional MCQs. That's going to help you, whether you're studying for your CPA exam, accounting courses, enrolled agent, some other professional certification. Invest in yourself. Good luck, study hard, and of course, stay safe.